I've seen and worked with hundreds of small businesses. Here's what the ones that grow actually do differently. Hi, my name's Sam and I'm the founder of Ascenso Accounting. Most business owners I speak to only get to speak to their accountant once a year. I'm fixing that and setting the new standard. This is the most common mistake I see business owners making with their money. So the main mistake I see is not separating your personal bank account from your business bank account, not isolating yourself from the business, especially when you have a limited company. When you have a limited company, it is a completely separate legal entity from yourself. Therefore, things are slightly more complicated. A lot of people use their limited company bank account to pay for things that are personal in nature. And that's okay, but it can be really hard to track certain things and certain tax implications can come about. Someone might want to come to me and really understand their business in a really granular level now. With regards to the tax implications I mentioned, this is what could happen, worst case scenario, right? When you take money out of the business, it goes into something called your director's loan account. Initially, it'll show that you owe that money back to the business. If you're taking lump sums out of the business and calling it a salary, but then throughout the month you've got a bunch of transactions that are personal in nature and you're not really thinking about it, it can make things really difficult. When your director's loan account is overdrawn, what the majority of people do is they declare a dividend, right? And you'd pay personal tax on that. However, a dividend by definition is a distribution of profit. So if there's not the profits to warrant that dividend being declared, worst case scenario is you have to fork out for something called Section 455 tax. Section 455 tax is a tax to stop you taking too much money out of the business. As a director, you have a responsibility to run the business in the best interest of the business. So if you're taking too much out of the business, you're not setting that business up for the best success. HMRC would penalise you, and this Section 455 tax is 33.75% of the amount you're overdrawn by. Now, this is a withholding tax. You can get this tax back, but the only way you can get it back is you either wait for the business to become profitable to warrant declaring the dividend, or you have to pay this money back. This is what separates the businesses that scale from the ones that don't. Having systems and processes for how you price your services is so key. It's one thing starting a business and getting to a certain point, but if you want to scale, there needs to be some consistency with how you price your service. Something I use as an example is a software called Socket. All my pricing and ideology is built into the software, so every client is priced consistently. As I grow, let's say I wanted to hire someone to do that side of the business for me, that there is already a process for how they can follow that. It's so important that as a business owner, when you're growing, that the things that are naturally inside your head are put to paper so other people can follow those processes, and then your business isn't revolving around you. The second biggest mistake I see business owners make is not reinvesting surplus money back into the business. Very easy for that lifestyle creep to come in. This is why most businesses plateau at the exact same point. It's very easy, right, as you're growing your business to find it really fun. Every client that you sign is something new, maybe you can afford, something you can level up on in your life. But if you have that mentality, you're not going to scale that business maybe in the way that you want to. This is what I do. And I'm not saying this is the right thing to do, but it's how my brain works. And I think I'm very good at isolating myself from my business. I start by creating a budget, and I have my out wants and my out needs. And I'm realistic with what I spend, right? It's very easy to pull your personal bank statements up, go down it and fill the boxes in. So I know that for me to not just be locked up in my apartment all day, I need £3,000 a month. That's my number. And regardless of how my business performs, I will continue to take that same amount of money out because I don't need to take any more out. The more clients I take on and the more my business grows, therefore, the more I can reinvest back into the business because I'm not allowing my lifestyle to creep up with the number of clients that I sign. Because I think in this way, what I'm doing now to help me grow my business is think, okay, as I grow, where am I going to feel squeezed? And then when I identify those areas, it's like, what can I bolt in now that will alleviate those pressures in the future. Because my business can afford to, now I'm trying to implement these things now, so that when I really, really need that thing in a couple of months' time, nothing will feel like a reactive decision. And the people that I bolt in now in a subcontractor capacity will be so in tune with how my business works that it'll just be flowing. This is a green flag versus a red flag with what I notice when I take on a new client. A green flag for me would be a business owner being honest with themselves and realizing what they're good at and what they're not good at. Most business owners are good at a very particular thing, and that's why they've had the confidence to take a bet on themselves and start a business in that particular skill set. But no one's ever told them or taught them how to run a business. So now all of a sudden you're wearing so many different hats that you've never worn before, and having the self-realization to realize what you're good at and what you're not good at is really, really important. A red flag for me would be a client comes on and they tell me that they've never logged into their accounting software ever. When I hear that, I know there's just going to be loads to iron out and loads of good habits to form, which is all good. Sometimes it's that the business owner doesn't really care about the figures, but other times actually it's because they don't know what they don't know, and maybe their previous accountant has not really showed them how to use it properly. I think a lot of accountants get this wrong. I think accountants see a client's bookkeeping software as a way to make their life easier, whereas for me, it's for the client to see how their business is performing, but not enough accountants empower the client to understand these things. I think in accountancy and any service-based business really, there are 3 qualities that you can choose from, but you can only have 2 of them. And these 3 qualities are price, timeliness, and quality. So if you wanted something cheap, but you wanted the quality to be really good, that person's not going to prioritize you, because they're going to prioritize the people that are actually paying for what they know their value is. Now, if you wanted something quality and timely, it's not going to be cheap. And the issue that I have in the industry anyway is I think there's this real expectation gap between what a person thinks an accountant could or should do, and the people that try to back down on price, I think I've only ever had an accountant that maybe works in a once a year capacity. So with that in mind, they've never had someone to perhaps push back on their beliefs and help them navigate their business and get a better result that year. They've only had someone tick the boxes for them at the end of the year. They're meticulous with cash flow and their margins, and they're really interested in the figures from their business. I mentioned earlier that accountants perhaps use a bookkeeping software to make their lives easier. The clients that I see get the best results do use it as their source of truth for their business. Whether you're a service-based business, whether you're a product-based business, margin is everything. You can have an idea as to why you charge a certain price for that service or charge a certain price for that product based on the time you think it takes to deliver that service or the cost of forming that product, and therefore you have an idea as to what margin you want on that cost. That idea in your head compared to what actually happens in real time can be different. And if you haven't got the right data in front of you to back that up, it's really hard to ask and answer the right questions. I've just mentioned about using your bookkeeping software as a source of truth for your business, right? And the first thing that I do with clients is I get their bookkeeping software talking in their tone, the words that they would use in their business. And I challenge you as the business owner to have a look at your business bank account. And if you were to look at the things that go out of that bank and you were to put them into pots, what would you call those pots? Within every accounting software, there's something called the chart of accounts. And this is a big list of all the codes that transactions can be coded to. Wouldn't it make sense if there were codes for those pots that I've just told you to think about? Like, this is possible, and not enough business owners think like this and customize the chart of accounts to actually suit their business. Once you've customized your chart of accounts, get your profit and loss set up correctly. So obviously you've got sales at the top, but I think going one better than that is thinking about the services that you offer, the products that you sell, and renaming sales to be the service that you offer. And if you have 3 different services, then have 3 different sales codes. So you can track which one's bringing in the money. Underneath that, you've got your cost of sales section. So if you're a service-based business, this might be chargeable staff's time. If you're a product-based business, then this is the materials that go into the product that you sell. You'd be amazed by how many clients that I see where there are cost of sales transactions in the overhead section of the business. Like your tax position at the end of the year will be completely the same. However, when you're actually using that software as a source of truth for your business, if you've got cost of sales transactions in the overhead section, it's impossible to track your margins month on month. And then how can you actually see whether you're pricing things correctly? So this has been a video on what businesses that grow actually do differently. I'm new to YouTube, but I've been told that I'm good at de-jargonizing certain topics. So if you like this and you want to see more of this, please like and subscribe.